XRP just experienced a stunning one-day surge during which it gained over 20% in the span of 20 to 30 minutes. Furthermore, XRP's price is beginning to consolidate and correct, and there is a plethora of additional promising news for the broader crypto industry that will surely cause XRP's price to soar to unprecedented heights, even though most people are presently oblivious to the macro-environmental factors that have contributed significantly to the recent spate of crashes. Raul is going to fill us in on all the details today. What I discovered in today's video is something I am really looking forward to sharing with you all. Therefore, let's go straight in. Before we get into this incredible news, I just wanted to mention in yesterday's video that I opened 3 long positions for XRP. Between 48 and 50 cents, I opened those 3 positions. Well, it was a fantastic chance to earn a ridiculous amount of money, so naturally I cashed out on all 3 of those long XRP bets. Throughout the duration of my long XRP holdings, which lasted for approximately 30 minutes, I managed to earn around $10,000. I will announce these rolls in my YouTube video if you guys would like to be a part of them. In order to open them on the same exchange as me for the same or similar entry fees, be sure to sign up for Margex and hit the subscribe button. Plus, if you trade cryptocurrencies with me, you'll airdrop a ton of incentives. Now that we've gotten that out of the way, let's get into Raul's incredible commentary. Since the economy has been moving at a snail's pace, we have been injecting stimulus into the worldwide market. With slowdowns in both China and Europe, the ISM report has been stumbling along the bottom. And you know what? One of the elements that makes it all work wasn't quite cooperating. The Federal Reserve signaled that it was the US rates first, and thus things began to move. However, dollar is the most important. This dollar has been holding its own. Tighter financial conditions brought forth by a strong currency are bad for markets and economies. Typically, a lower dollar is necessary at this stage of the cycle, when inflation is either non-existent or is decreasing rapidly. That leads to expansion all over the world. Janet Yellen made 2 trips to China earlier this year, in case you forgot. I take it that talks revolved around the possibility of letting China stimulate without jeopardizing the yuan. The yuan would have crashed if China had stimulated while the dollar was high, and that's something they just can't handle. It is their deepest desire to maintain a steady currency. We understand the need to stimulate, and we are currently experiencing debt deflation, but we are unable to do it on our own. Therefore, we are appealing to you for assistance. Of course, Yellen would have responded with, what can I do? Of course, lowering rates is the obvious solution. Yes, we understand that is how it goes. We can definitely do it. At that point, though, it's as if you're told to devalue the dollar. The Bank of Japan is next. Here, the Bank of Japan plays a significant role. Additionally, the Bank of Japan has been steadily declining and has begun to signal its intention to take action regarding the matter. Thus, the market for eurodollars is the Japanese financial market. Actually, Japan is the hub for all of the world's dollar loans, and there just weren't enough dollars in Japan. Therefore, they had to do this. Unfortunately, there just aren't enough dollars in the world. Consequently, both Yellen and Powell will have addressed the Japanese. The basic premise is that when you interfere with the value of a currency, you are pumping liquidity into the market. Join us in bringing the dollar down in value. Because this is how your money system works, you have the opportunity to be the major player here. So long as we both reduce interest rates, the Chinese can stimulate their economy without jeopardizing their currency stability. I've mentioned this as the overarching goal, and it's something I wrote about for some time. Then JPY intervention began. Now, the yen is interesting since many people borrow in it due to its low cost. This is especially true when the Japanese additionally increase interest rates prior to putting their money into other assets. The funding trade is what it's called. Well, that's great and all, but it can't handle regular volatility. But when the Japanese started meddling with the currency, it began to force people out of their jobs. Those jobs start to pay less. They are so compelled to decrease danger. Value at risk VAR and hedge funds are the terms used by banks to describe this. They usually manage to pull it off even when the financing currency or any major currency experiences large fluctuations, is starting to liquidate other positions, which is having a knock-on effect for riskier assets listed on the Nasdaq as a whole as consumers cut back on higher volatility positions. When things start to move in tandem, which they weren't before, you notice a correlation in a single event. The reason behind this is that everyone gets compelled to vomit at the same moment. Then the risk vomiting began and soon became a serious concern. What the F are you doing? Is how we feel right now. The bags I have are being nuked by you. Okay, I see, but there is a more important game that needs to be played. Incorporating liquidity into the system is their ultimate goal, and a change in government is necessary to make it happen. Consequently, a macrospasm is caused. This kind of macrospasm is quite prevalent. Every business cycle, especially around regime changes, you usually get one. Here we are in 2018. The regimen of hiking came to a close at that point. This spasm occurred at the Powell pivot point, when the market essentially compelled the Fed to change course. Brawl Powell basically means that the recent market fluctuations caused by the Japanese government's decision to increase interest rates, which affected numerous tech stocks and other currencies that rely on borrowing the yen for trading, will be temporary. As we have observed, large market dumps are typically followed by a sharp and steep correction that occurs very rapidly. These events do not occur over an extended period of time. Naturally, we know from experience with XRP that its price will surge with just a small amount of liquidity. Finally, after a 20% price drop, it would be extremely irresponsible not to purchase XRP. If you don't do this and begin a long position as soon as it hits bottom, you will miss out on a fortune that might change your life. The same holds true for all of these assets, including Bitcoin, Ethereum, Solana, and every other one. On the same day that XRP was booming, Solana had an 18% run, despite the fact that there was no big news outside of Brazil issuing Solana ETFs. This simply goes to show that these bad days are fleeting. There's no need to dwell on them. Purchase those bottoms, you dweebs. On a bad day, it usually hits bottom around the closing bell. You'll have a good idea of the direction things are going in after a day or two, and then you can make a decision based on that. I just made a ton of money on Margex and gave you the receipt, so I know it's possible for you to do the same. In light of the foregoing, Raoul Pal will elaborate on a few key signs that you should keep an eye out for. Additionally, this provides a very clear indicator with regard to the future of the investments. They are indicators that are a bit behind the curve and typically occur after many of the recent occurrences. Because of how this can affect your financial future, I hope you all paid close attention. Now is the time to start ... cycle. The business cycle is at rock bottom, not peak, as I mentioned before. Recession. Recession is all anyone can talk about. The forward-looking indicators factored in a lot of that last in 2022. Here we have the economic cyclical components, sluggish sales of cars and other vehicles, as well as miners and other industries affected by the business cycle. There has been no change in the business cycle, sure, but see, it fell, so the argument goes, it did in fact fall. At the bottom of every cycle, it occurs. We are currently in the midst of this correction, which is common. Thus, you can observe that there is a secondary dip preceding the rebound over the past the previous 2 decades worth. I believe that sums up our current situation. It's background noise, simply because the liquidity and financial conditions determine the prices of the markets in which I primarily operate, which are technology and cryptocurrency. We have reached a somewhat slow position in the economy, though, when rate decreases are all but guaranteed due to factors like unemployment. It has been my opinion for some time that the unemployment rate ought to go up. In my opinion, it won't go completely bonkers, but we've reached the point where we can't go any further. Percentage of the unemployed who are members of the Federal Reserve who are positively disposed. As a result, the Fed has made it quite apparent that they intend to lower interest rates. They might arrive sooner or later or inject liquidity in other ways. It's hard to say for sure. Whatever the case may be, the Fed is very concerned about the growing unemployment rate and the dropping inflation rate. Therefore, lowering rates is universally approved, and doing so facilitates the influx of money into the economy. What transpired was that the Federal Reserve began to abruptly announced that they would likely cut interest rates at their next meeting, which caused a chain reaction involving the dollar index DXY, 10-year bond yields, and Fed rate cuts. And it was that triggered everything. A number of rate reduction have been factored in. Their pricing was previously unconsidered, but I now believe they are more accurate on how